this is a dilemma, because if you have less stress on the market, it is very likely that in the short term, the Crédit Agricole SA, the big shares, will rally much more than the Caisse Régionale. So if you want to play a rebound on the market, don't buy the Caisse Régionale. Buy Crédit Agricole SA, or even better, buy BNP or Société Générale or Dutch Bank. That's definitely the case. After, if you want to have a set for you, for your grandmother, for the next 20 years, what do you prefer? Do you prefer a bank with 30% market share, or do you prefer a bank with low market share in wholesale banking? Do you prefer a bank which has 18% core tier 1 ratio, or do you prefer one which has 8% ratio, and even the 8% there is some tricky stuff like double counting the equity in the insurance company and in the bank, or like having a cross guarantee with the Caisse Régionale, which gives them artificial equity they don't have. So that's at the end of the day, in both cases you have a normalized P around 3. But do you prefer a normalized PV around 3 of an overcapitalized, safe, huge market share, etc., or do you prefer a P of 3 of a company which has a bad investment track record, who have a lack of equity, because there is definitely a lack of equity in Crédit Agricole SA, not at the level of the group, but at the level of Crédit Agricole SA. And after you have also a way to measure what is the quality of a banking business. In the past, people used to look at the ROE, return on tangible equity. The issue with this ratio is the E has changed so much in the past few years because of the crisis. 5 years ago you could have a 7% tier 1, which means 5% core tier 1. The analysts were saying you were overcapitalized and bad capital allocator, and now they are telling you should have 11% core, deducting everything everywhere. So the issue is the ROE, you cannot measure it. What you can do on the other side is to look at the weighted asset of the bank, which measures the risk taken by the bank. It's not perfect, you can always say the weighted asset, they are too low, they are too high, we don't know, but at least it's something which is a little bit scientific, and you can at least compare between two institutions, and you can look at the return on the risk-weighted asset. After you divide your return on risk-weighted asset by the level of core tier 1 equity you think a bank should operate with, and you get the normalized ROE. What's very interesting is the Caisse Régionale. In the past, they don't have a so terrific ROE, but because they had so much equity that the ROE was lower than peers. But if you look at the return on weighted assets, you realize they are best in class in French retail banking. The average figure is 1.3% net of tax. The best one are like it go from the worst go from 1%, and the best one are at 1.5. Imagine if you want a 10% core tier 1 ratio, that means that you are doing in average a normalized return on equity of 13%. And I'm not speaking about last year, I'm speaking about something done over the past 5 years, which your 8 or 9 or 10 year of crisis. So looking at the bank, you should always normalize the cost of risk, of course.